Welcome to Turning Hard Times to Good Times. I'm your host, Jay Taylor. I'm really pleased to tell you that Adrian Day is with me now. I think this is the first time I've had Adrian on Turning Hard Times to Good Times, but it's really good to have him because he's a very well-known, respected analyst, global analyst, actually. And he's got a pretty darn good following over the years because of his success. And patient investor, obviously, value investors have to, by nature, be somewhat patient because you've got all these guys that are trying to get rich quick. They're, pumping money into these hot stocks, and boy, it's hard to sit by the sidelines sometimes and just depend on value to finally be recognized. But Adrian has had the patience and endurance to do that. So glad to have you, Adrian. Thank you for joining me today.
Well, thank you, Jay, for asking me. Yeah, it is the first time I've been on your show,
Yeah,
but
I
we've
was
obviously seen each other many times.
many times. In fact, we've been on the stage a couple of times, at least that I can remember, in panel discussions. I remember one time with Dennis Gartman sitting next to you, and I was on the other side of you.
Yes.
I don't know what's happened to Dennis. Haven't seen him around too much lately, but it's good to see you. I should tell people AdrianDayGlobalAnalyst.com, AdrianDayGlobalAnalyst.com. It's where people should go. If you like what you hear from Adrian, you might want to check him out and learn more about his service. All right, Adrian, I'd like to start out by asking the question that we hear so often with thoughtful money, and that is, what is your current assessment of the global economy and financial markets?
Whoa, that's a big question.
That covers a lot of territory. Yeah.
I'll try to keep the answer brief. I mean, obviously, there's a lot of uncertainty at the moment with the new administration in the US and the tariff policies and other policies, frankly. So a lot of uncertainty, and that comes amid what I see as mostly overvalued markets. Most of the developed markets are overvalued to greater or lesser extent. We're also seeing slowdown in the global economy. China's economy is slowing. As well, frankly, as other regions, the US, Britain. And so this new uncertainty comes in that background, which was happening, before Trump got elected. And so what that means for me is a little bit more caution in investing. Yeah, a little bit more caution generally in investing. I should say I don't say I want to increase my cash from 5% to 15% because of Trump. That's not where I start. But if you start by looking at individual companies from a bottom-up approach, within a global framework, like, oh, maybe not now because this company will be affected by tariffs, or maybe not now because the Middle East war might expand, you just come to a point where you don't find enough things you want to invest in. And so your cash goes up by default, but certainly more cautious now than we have been.
For some time.
Yeah.
So what about the Trump tariffs? I mean, does that cause you a lot of consternation? Are you really concerned about that?
Oh my gosh. You know more about that than I do. Yeah, I'm not sure I have anything really brand new to say on that. I mean, obviously we're seeing a lot of flip-flops, whether this is four-dimensional chess or whether it's reactions from friendly nations, reactions from people in the White House. Obviously, the last flip-flop we got was when the 10-year yield rose dramatically. And I suspect Besant sent Howard, what's his name? Ludnick, whatever his name is.
Yeah, Ludnick, yeah.
And Peter Navarro, he probably sent them to the East Wing to pick up coffee and went in and talked to Trump and said, hey, yeah, just pause for a while, will you?
Yeah.
So, I mean, they're clearly concerned about market responses. I think they're concerned less about stock market responses than they are about the bond market responses.
Mm-hmm.
We might get into that later, but so anyway, a lot of we can call it what we want, but flip-flops or changes. So it is a dynamic situation. I mean, I look at how individual companies might be affected.
Yeah.
So if I'm looking at a Scotch whiskey manufacturer and something like 80% of their sales go to the US,
Yeah.
well, let's factor that into whether I want to buy them or not.
Sure.
Yeah.
Okay. Well, so you do a bottoms up approach. That's in general you do, and then within the context of the global or the local markets, I guess.
Exactly. I mean, you remember, was it Peter Lynch famously said, Peter Lynch, a great investor, of course, famously said something like, if you spend 20 minutes a year looking at the economy, you're wasting 15.
Yeah.
I butchered it a little bit, but that was basically his approach.
That's
I
the
don't
idea.
quite go that far. I mean, clearly to me, the macro is important, because if I think that oil price is going to go up dramatically and interest rates are going to come down significantly and the dollar's going to fall, I want to be investing in different things.
Right.
I think the opposite.
Right.
At the very minimum, my great little bottoms up company is either going to have headwinds or tailwinds.
Right.
And I would rather invest when they have tailwinds.
Well, I think so. Do you see sort of in the short term, do you see a stagflationary environment? Or I mean, yeah, the reason I ask, I was just listening to Daniel DiMartino Booth, I think this week after the Fed came out with its latest pronouncements, and she is concerned that she sees a great deal of weakness, especially in the retail sector. Housing and rents are coming down. I mean, there's a lot of, maybe the labor market isn't as strong as Trump pretends it is, and so forth.
Yeah.
So she is not concerned about stagflation. She thinks the Fed should really start to pump money into the system now, or should lower the rates and so forth. On the other hand, you've got guys like Peter Schiff, who's suggesting that no, you don't want to drop interest rates. That's going to just make things worse. Anyway, we're damned if we do and damned if we don't. According to him, he sees inflation, nothing but inflation, because you have the problem with financing the debt. How is it going to be financed, especially when Europeans, or I guess foreigners in general, don't have an appetite to buy U.S. treasuries anymore? So where do you come down on that? I mean, is it short term? To me, it seems like Daniel DiMartino Booth could be right. Longer term, I'm wondering, probably Peter Schiff is right. I don't
Well,
know.
that's probably correct. I'm certainly concerned about I am concerned about stagflation, but I'm much more concerned about the economy than I am about inflation in the near term.
Mm-hmm.
So, as you mentioned, but the economy to me is not anywhere near as strong as the headline numbers and the narrative would suggest. And that's been true for the last, 6 months or more. But I mean, before Trump became elected.
Yeah.
If you look, just to give a couple of examples, I mean, if the headline is strong, but you look under the hood and look at the details, or look under the bonnet, I should say, things are not as rosy as they seem. So, consumer spending, everybody says, oh, the consumer's the bedrock of the US economy and consumer spending is strong. But if that consumer spending comes at the same time as credit card balances are increasing tremendously and credit card defaults are going up, then the consumer's clearly not as strong as those headline numbers would suggest. We can talk more about that if you want. Another thing would be the labor market. Yeah, if the last month we had a beat on new jobs created, but they revised downwards the previous 2 months by more than the number of new jobs created. That doesn't sound so good. And if you look at the last 12 months and you see literally the majority of the new jobs were either government jobs or part-time jobs, maybe that's not such a strong labor market. Unemployment, of course, is low. But if your denominator, if your labor participation rate goes down, then clearly your unemployment rate can stay the same, even if the economy is, even if the number of people working is not going up.
Yeah.
So I definitely think that the economy is heading down. I don't think we're going to see, I would regard inflation as more stubborn. I don't see a big increase in inflation in the near term for two reasons, frankly. Everybody says, oh, even Jerome Powell yesterday said tariffs are inflationary. I don't think that is true. It's certainly not a given.
No.
You know, you raise prices because of extra taxes, which is what tariffs are, and you reduce demand. Strikes me that the deflationary more than inflationary.
Right.
We only have to look at what happened in 1930. That wasn't exactly a great inflationary boom.
Yeah, no, that's right.
So I would say inflation is stubborn rather than we're going to see a big increase.
Right. With regard to consumer spending, I wish I could remember the numbers, but I saw a chart, statistics, where most of the consumption is coming from the upper, I don't know, 10%, or the really wealthy people are spending the big bucks. And then a lot of the, the people are tapped out on their credit cards, and where are they going to go? And I mean, it's just, I think, we've had this redistribution of income to such a great extent over the decades. And I know Trump is trying to reverse that, but I think it's very difficult. And once you've offshored your wealth creating industries like mining and manufacturing and, those kind of industries that can pay high wages, it's hard to see, in my view, a middle class coming back. But I know that's his aims, and I applaud that, honestly, but I don't know if tariffs are the best, but I agree with you on tariffs, because I think maybe the first round, the initial shock, maybe you see some prices rising, but then because those prices are higher, you reduce demand, as you said, and then you actually, as you say, and Trump's first term as well, we didn't have inflation when he put on tariffs, but then the 1930s as well. So yeah, I think you're right, and it's a deflationary, but you got to pay for those treasuries, and you got to create money. You got to create. Somebody's got to buy treasuries, right?
No.
Who's going to buy them?
That is the biggest thing that's going to happen this year. That is really the big story for the markets,
right,
in my view. And so at the moment, as you know, most people know, but I'm sure you know, because the debt ceiling hasn't been increased, and because Janet Yellen left Trump with an empty treasury. I mean, you remember that infamous interview she gave on the Friday evening before Trump was sworn in on the Monday, where she basically said, we're going to hit the ceiling on Tuesday, Trump's first full day of office, good luck. I mean, I thought that was unbelievably outrageous. And of course, the spending that they did, Biden and Yellen did in the last 2 months after the election, basically, they spent every single dollar that'd been appropriated. They just spent it. So that the cupboard was literally bare when Trump took over. Now, with the debt ceiling not having been raised yet, I'm sure you know this, but the Treasury has not issued any net new treasuries this year. It's only been, if treasuries roll over, they've replaced them with new issue.
I see.
So the longer that, and the debt ceiling is a different issue, but so I don't want people to think I'm all in favor of raising the debt ceiling. I'm not.
No.
But the longer that the debt ceiling is not increased, then the more treasuries will have to be issued in a shorter period of time. So July the 4th was the deadline. That's not going to happen, I don't think. Unless they pull that debt ceiling out of this big, beautiful bill. I don't think we're going to get it by July 4th. But if it doesn't happen till the beginning of September, then you've got X amount of treasuries, but you've now only got 4 months to raise it. If it doesn't happen till November, you've still got X amount, but you've only got 2 months. So you've got two problems. One is they can't raise any more money at the moment. But the second thing is, once they do have that ability to raise more money, You've got a very compressed time frame to raise it, so you've got a huge issuance. And as you alluded to, or as you mentioned, there's fewer and fewer willing buyers, certainly willing buyers at today's interest rates.
Right.
So no one's going to be buying. I don't know anyone who would buy a 30-year government bond, US Treasury at less than 5% with the intention of holding it for 30 years.
No.
I mean, it's just not a good investment, right?
No. I mean, there's some speculators on the direction of rates and maybe a quick profit. That's
exactly. And then people like pension funds and insurance companies that have to buy long duration to match their liabilities.
Right.
But they can't issue any meaningful amount of long-term bonds at today's interest rates. So that's the second part of it. Even after they've raised the debt ceiling, actually selling those things at a reasonable price. Now, there'll be gimmicks and arm twisting. You know, maybe Trump calls Starmer and says, "Hey, we gave you a good trade deal, Starmer. Can you buy some treasuries to help us out?"
Yeah.
I'm sure that's going to be part of the conversation. We're seeing what the Fed is doing. The Fed, as bank regulator, they've absolved Wells Fargo of their 2008 sins. And of course, Wells Fargo was by no means the worst in 2008. Mm-hmm. They were punished, frankly, because of that infamous closed door meeting where John Paulson actually locked the door and said the bankers weren't getting out until they agreed. Wells Fargo was, remember that? Wells Fargo was the one that kicked up a fuss.
Yes.
They got punished. But anyway, they've now been absolved of their sins. I'm sure part of the deal is put that money, about 50 million now, billion rather, put that money to work in the Treasury market. We'll see what they're doing with the SLR. Mm-hmm. Okay, Jamie, you don't want to have to put so much money on deposit at the Fed. And by the way, under Senator Cruz's measure, we're not going to be able to pay you interest on that anymore. Maybe you'd like to buy some bond treasuries instead. So they'll piece together buyers. But honestly, Jay, and sorry, finish with this. I do tend to go on tangents. To me, what is, I think, inevitable is that before the end of this year, and I say by the end of summer, the Fed will switch from QT to QE.
Yeah.
We're already seeing that. I thought it was really interesting in the press conference yesterday. We're talking on Thursday, so Jerome Powell's press conference yesterday, where he said, you know, the Fed's keeping interest rates where they are, but we're continuing to reduce our balance sheet. Nobody freaking asked him a question about that. So no more was said about it. But look, already this year, they've gone from 30 billion a month reduction to 25 billion a month reduction to 5 billion.
Yeah.
5 billion a month on a $7 trillion balance sheet is a rounding error. It's meaningful. So QT, in my mind, is basically, effectively, it's over. That's been over.
Right.
And the next move is the Fed is going to start QE.
Yeah. Well, and as you say, if that in that compressed period of time, they have to raise a heck of a lot of money. Where is it going to come from? I don't know. But here's the thing, Adrian, that I see. The major difference now from 2008 and other times of crises that have occurred in the markets and war and so forth, you know, the dollar would always get stronger, the rates would come down, money would flow into the United States. It's not happening this time. Why do you think that is?
Well, it's a long-term problem.
Yeah.
Or long-term factors. Mm-hmm. The weaponization of the dollar is obviously a thing that foreign official entities are concerned with.
Sure.
And then this year, basically, I mean, both by their words and by their actions, the Trump administration has kind of said that they don't really care about foreign investors and that they don't care about the value of the dollar. Yeah. So if you're a foreign investor, you're a Swiss money manager, you're a British pension fund or whatever, you're already overweight US, right? Because that's been the place to go for 20 years. So you're already overweight, and the new government says, we want a lower dollar. So would you buy bonds when you're at 120, thinking it might go to 150? That's reverse.
Yeah.
I'm thinking of a British pound. Think I'm probably going to lose money on my currencies when I buy this. And you know, they're making it pretty clear that they don't really care whether we invest in their markets or not.
Yeah.
So I would not be, people are going to be looking elsewhere.
Yeah. Well, so where are people going to? I mean, where are they going? Where are they going if they're not investing in treasuries? What are they? So the Europeans are keeping their money at home. They're in trouble too, though, aren't they? Fiscally, the European Union. Yeah. So
Sure. Well, I mean, it depends whether you're talking about an official entity such as a foreign central bank, or whether we're talking about money managers. I mean, I think money managers, pension funds, whatever, are going to, everything happens at the margin, right? But they're going to stop or reduce, they're either going to reduce, stop, or reverse their purchases of US assets, take profits in the US market. I mean, remember, foreign investors have huge profits in US equities, magnified by an increasing dollar over time. So their profits are even greater than ours are. And their automatic inflows, you know, most of the big pension funds and big money managers in Europe have been automatically reinvesting in the US market in much the same way that 401s have just been automatically putting money back into the market. That's going to slow down, stop, or reverse. And as they take profits, just put it in a lot of different places. It might be in European stocks that have or global stocks generally that have underperformed. It might be specifically in emerging markets, which are which have underperformed dramatically and are very inexpensive on a relative basis. Obviously, it's into commodities, which, as you know, are trading more or less at 100-year lows relative to financial assets. So, yeah, I mean, I think they're just going to start looking for other places to go. And we've seen a bit of that, obviously, already. We've seen it with gold. We've seen it with European markets, which have seen more inflows this year than they have, you know, in the last few years. And that's not because Europe's doing so well.
no, no.
It's because people want somewhere to put their money other than the US.
Yeah. Well, it's a big change, and I don't know if the dollar milkshake theory is being exposed now. I mean, it used to be that you could count on money flowing back in here, but obviously that day is over, and I don't know if you can blame it on Trump entirely. I think it's, you know, the math speaks for itself, doesn't it? I mean, you cannot have, and I saw the other day that we're getting close. The interest expense is not all that far from being equal to Social Security payments as well. So, you know, I mean, so clearly the math doesn't work, and you don't have to be an Einstein to understand that, I think. So, you know,
no, and as you say, these are long-term trends, and you know, we don't want to get too political here, or maybe you do, I don't know, but I'm not getting political here. We might say that Trump has made things worse. But these are long-term trends.
Right. Correct. And speaking of long-term trends, Adrian, the yen carry trade, you know, the yen interest rates are going up like mad now. They're just, you know, they can't suppress those rates on the long end of their curve anymore. And so that's been a source of financing US treasuries as well, right? You'd borrow cheap in yen and go buy treasuries, get 4 or 5% on the treasuries, and borrow a fraction of a percent in Japan. And now with the dollar is going down at the same time, and your value of your bond, your treasury is going down too. Wow, I mean, that's a bloodbath.
No, absolutely. And so they're both going in the wrong direction. I mean, you still have the differential, of course.
Right.
You know, if you'd not looked at things for the last 40 years, but came to it fresh today, you'd say, oh, I've got a good idea. Let's borrow in yen and buy dollars.
Yeah, right.
But if you look at the direction, everything's moving in the wrong direction.
Right. Well, let me ask you this, Adrian, since you are such a known for your global investing, then would you, maybe you are in your funds, taking some money out of the US and putting it in some of these evolving markets?
Yeah, I'll be honest with you, we've been underweight the US for several years now,
Yeah.
because things just didn't look like good value to me.
Hmm.
But yeah, we're certainly, again, we're bottom-up investors, but it's a matter of bottom up within a macro environment, and then where do you find the good values? And we're not finding very many good values in the US right now. I'll clarify that or qualify that in a second. But we are finding good value in many, many markets. I think, surprisingly, given the government over there, the British market has a lot of very good quality companies. We're looking at the major markets in Asia. We are buying Japan. We're buying Singapore. I'm also overweight, certainly overweight relative to most managers. We're overweight Hong Kong, China. For Hong Kong stocks, we only ever buy stocks that trade on Hong Kong. So we don't buy, but of course, a lot of those are essentially Chinese companies, or even if they're Hong Kong companies, they're definitely tied to the Chinese market. There's some very, very good, well-run Hong Kong companies that are extraordinarily undervalued. One has to recognize, you know, there's a very high risk in those markets as well, the Chinese economy, but also the possibility of something happening to Chinese stocks, such as happened to Russian stocks. And so that risk is a small risk in my view, but obviously a very, you know, if that risk did play out, it would be devastating if suddenly your stocks become worthless. So we're not, although we're overweight, not overweight by an enormous amount, but yes, some really good quality companies there that are really quite inexpensive. I'm talking about companies trading at fractions of their net asset value, like quarter or even as low as 10% of their net asset value, growing, you know, 2 times earnings and growing earnings. So very cheap. And then we're also looking at what used to be called emerging markets, although emerging markets now tend to be you know, the really, really small ones. So we avoid those. So let's call them developing markets. Places like Argentina, which is its own story, Brazil, Thailand, places like that, which I would still call emerging markets or but developing markets, if you like. So yeah, we're certainly finding some very good companies in those markets, which are both large and small markets. We're also finding, obviously, but we're investing a lot in the commodity space, the resource space, including gold. And then, frankly, we're also finding in the US market, we're finding a lot of areas of the market that have really lagged for a long time. So that might be small cap value, and it might be defensive income stocks that have lagged a lot. So, for example, I like some of the business development companies. I don't know if you know that sector. They lend money to small private businesses. But you can get yields of 9–10% from good quality BDCs, fully covered by earnings. I mean, there's obviously a whole story there about how they react during recessions. You may not want to get into that, but what I'm saying is there are sectors of the US market that have lagged tremendously while everyone's been focused on the big momentum growth stocks.
No, exactly. The get rich quick crowd, and that's the way it is. So yeah, well, that's what value investors do. But again, you have to be patient, don't you? You can't just you know, you want your cake and right away. Not the way.
Well, value investors are typically too early anyway. I mean, that's
but you have to wait till other people catch on, and sometimes that can go on for a long, long time.
Sure.
So you do manage money for clients, right?
Yes,
For
correct.
individual clients, and to a certain extent, you tailor it to the needs of the individual clients, or do you tend to put certain clients in higher risk asset portfolios, or how do you?
Yeah, well, we have certain portfolios. So we'll have global portfolios that are conservative, mid-risk, or aggressive, and then we have dedicated gold and resource accounts.
Mhm.
But we pride ourselves, or one of the differentiations we have is we don't manage to a model. We do individualize portfolios, obviously depending on the client's financial circumstances and goals, but also frankly just on the client's desires. You know, if a person says they don't want tobacco stocks, you know, that's just a simple example. But let's say within the gold portfolios, we have clients who come to us and say, hey, I don't want you buying any of Franco's or Agnigos. I can buy them myself. I want to focus on the juniors. And we'll have someone else come to us and say, you know, I want a gold account, but, you know, I'm 70 years old. Don't buy me any of those juniors. Just focus on the good quality ones.
Yeah.
So we will tailor our portfolios to the person. And then lastly, I'll say this. We clearly, our portfolios will be different simply based on when the person opens the account. You know, if we've got 5% of our portfolios in Nestle, and someone comes to us today, I may not want to put 5% into Nestle. And so your account, even with the same objective, your account's going to be different from someone else's with the same objective. Now, I should just say that's what we do, and I think is a better approach. People who want tax losses, for example, will accommodate that. People who don't want tax losses will, you know, bear that in mind. But I should just say that, you know, there's if an investor manages to a model, that doesn't mean that they're necessarily being lazy, or certainly not necessarily a bad thing. If you invest according to a model, the big benefit of investing to a model is that everybody gets the same performance. There are no outliers, right?
Right.
And so from the day you open the account till the day you close the account, or till the 3 years later, your performance is going to be exactly the same as everyone else with that objective. And you know, that obviously is a big advantage. Right.
Well, so you're pretty specialized. I mean, you really have individual attention to a great extent, though, still.
Correct. And I think that's fair for clients.
And so I would think that you probably need fairly substantial investments to start with. What do you need, $1 million or something?
No, I mean, obviously we prefer larger clients. I always say a larger client, larger accounts will tend to do better, not because I ignore the small accounts, but because you can diversify more. And more importantly, with a larger account, I can be willing to put a smaller amount into a higher risk, but higher potential situation. What I say, honestly, Jay, and I appreciate you asking me these questions about what we do, but what I always say to people is we will take almost any amount of money so long as it genuinely makes sense. I'll give you 2 examples. I had a client, someone come to me once. He said he had over $100 million, most of it in treasuries and municipal bonds, earned more than enough money to live on. No problem. He wanted to open an account in gold stocks because he thought gold was going to do well. And he said, I'll give you 50,000. And I said, look, sir, first of all, that's an insult. You've got $100 million and you want to give me 50. But secondly, it's meaningless. Supposing it doubles and triples and quadruples, what difference does it make? He said, well, it'll be fun watching. And my response to that was, I'm really sorry, but I'm not in the business of providing you with entertainment. If you want to give me at least $1 million, it's not worth our while talking.
Well, of course.
Now, I had someone else, a very nice chap, just got out of college, said, I want to start investing early. I've heard you talk, and you've said the sooner one starts, the better off one is. But I can only give you 20,000 today. But I promise I'll add to it. I said, that's fine. That makes sense.
Yeah. Yeah.
And so we'll take a 20,000 from this guy, but not a 50 from that guy.
Right. I understand that. But that's very generous of you, also, because you're not going to make a lot of money on that young man right now, but longer term, who knows? And he's probably a very bright guy. He's going to work hard and keep up.
Exactly.
So, whereas the old guy wanted some entertainment, huh? So, yeah. Well, he could go out and do his own investing and you know, check out these junior mining companies. I mean, it's kind of fun. I'm an old guy, and that's what I do still. And
you're not that old, but
I'm pretty old. I got you beat. I've got more trips around the sun than you have, I dare say. But anyway, the reason I reached out to you, Adrian, was because of Origin Royalties, and I learned that your firm is a pretty big investor in royalties, and they just, I guess they're being taken over now. Or it hasn't occurred yet, but I guess it's going to occur. You've got Triple Flag is going to acquire them, right?
Right.
And so, okay, do you follow Triple Flag? Because I have it in my letter. I'm just wondering.
Oh, well, I do now.
Yeah. I mean, they've a pretty substantial royalty fund, I think.
Sure. No, what I like about Triple Flag is obviously they're well backed by Elliott. So, you know, they have a substantial shareholder with cash. They seem to be a really well-run firm. I'm very impressed with the way I'm very impressed with their, you know, public presentations, with their, the way they run the business seems very, very good to me. So all of that's good. I would say, and maybe this is not fair, I would say that until they did the acquisition of Origin for the big royalty on the silicon deposit, we can, you know, talk about that. But I thought their portfolio was not exceptionally exciting. Right? So well-run company, good balance sheet, obviously a deep pocket investor behind them, but not overly exciting assets. But we've opted. So let me just back up a little bit for people who don't know. Origin is a small company. It's a royalty company that earns their royalties by prospect generating. So they will generate projects, get other companies typically to come in and buy the whole project for a little bit of cash up front and a royalty. Well, one of the discoveries, actually, irony, it wasn't a discovery they made, that they acquired a company called Renaissance several years ago. And in fairness, they did acquire Renaissance because they saw this silicon project. So Silicon Merlin is a deposit in southern Nevada. Anglo Gold, one of the largest mining companies in the world, Anglo Gold came in and consolidated an area. They bought Corvus Mining. They bought some land that Coeur d'Alene owned, and they bought this area, the Silicon Merlin, and Origin retained a 1%. So this is obviously in a great jurisdiction, run by one of the top mining companies in the world. And it has grown in the last 3 years from basically zero resource, first to 3, then to 5. Now it's at over 13 million ounces.
Wow. Yeah.
So it has grown tremendously. And Triple Flag, obviously, Triple Flag is acquiring Origin, but they're spinning out everything other than the royalty on Silicon Merlin, which is going to be a cornerstone for Triple Flag in the future. Once that comes into production, and then everything else is being spun off. So we are definitely supporting a transaction. We're in favor of a transaction, and we want to keep at. We're opting for Triple Flag. I'm sorry, you can probably hear the noise outside.
Well, we got some thunder here in New York. I don't know what you're hearing in
oh, you're not hearing it. Good. Well, I love living in Puerto Rico and I love the Puerto Ricans, but they do have a habit of blaring stuff from their cars.
Oh, yeah. Well, we have some of those in New York too. But
Yeah.
so that's outside your house, so the car will drive away. But I don't hear it here.
Oh, you don't hear it. Okay, good.
No.
Sorry to
So
interrupt. And
yeah,
so we are definitely voting in favor of the transaction. We are making the option, the election to take Triple Flag shares because I think Triple Flag is a great company. But also, equally important, we are getting effectively at today's prices, we're getting Triple Flag at a discount.
uh-huh.
So we are still buying Origin, frankly,
Oh,
even though
okay.
it obviously popped after the news, because this transaction is worth $2.05, $2.10, and Triple Flag's at $1.90 right now,
Oh,
$1.90.
okay.
So for big clients in big amounts, we're still buying, opting for the Triple Flag, and then obviously we'll receive the rump Origin spin out.
Yeah. Well, that's a way to do it until somehow arbitrage or whatever steps in. I don't know, but yeah, that's good. So I wanted to ask you though, with regard to Origin Spinco, are you going to hang on to those? Do you think?
Definitely. I'm
Oh,
very, I mean, it all depends on the price, of
yeah.
course,
Right. Right.
but I'm very excited about that. First of all, this is, as I say, a junior prospect generating company that has a great balance sheet. They will wind up with about $16 million after the lawyers and bankers have raped them for the transaction.
They tend to do that.
Yeah, I mean, they did have like 25 million. And I said, whoa, what happened to your cash?
Is that right?
The banker alone is taking $6 million on this transaction. And I said to the guy, you know what? You didn't really need a banker. I could have told you this was a good deal.
Yeah.
But anyway, so they'll have $60 million in cash, which for a prospect generator is just a superb balance sheet. They will never have to raise more money if they don't want to. They will have positive cash flow coming in. So this is a junior exploration company with free cash flow. They have one earning royalty at the moment. It's First Majestic's Ermitaño project.
Oh, sure. Yeah.
Which is generating free cash flow to them and growing. There's probably another 7 or 8 years easily ahead on that deposit. And then they have several joint ventures and alliances. They have an alliance with Triple Flag as part of this transaction. Triple Flag's got an alliance with them in the Western United States. They've got joint venture projects under an alliance with Altius. Do you know Altius?
Yeah, sure.
Yeah. So they've got some good companies that are keyed in with them, and some really good projects. So we're going to be keeping this for sure.
Oh, good. And will it be trading right away?
Yeah, the idea is it'll start trading immediately.
It hasn't named, it's just Spinco at this point. We don't have.
Yeah, no, the interesting thing, I didn't know you could do this, but they've got permission from the TSX to keep the same name and the same symbol. So it'll be Origin, OGN.
So it will continue to trade even after this transaction.
Correct. Yeah. And it'll probably trade in the region of 30 cents when it comes out. I mean, right now, you know, the market's not giving it much value at all, but it'll probably come out at 30, 35 cents, which I think will be a very good value.
All right. Well, project generator, yeah, you know, I haven't been terribly excited with them over the years, but sometimes, again, patience is what's required.
Well, the difference with this prospect, I agree with you on the prospect generator model generally.
Yeah.
To me, the prospect generator model in practice has not lived up to the prospect generator model theory.
Yeah.
Agreed. The difference with this particular, and one of the reasons for that is, of course, is that these companies have continued to issue shares and dilute.
Right.
The beauty of Origin is that with their balance sheet and with their free cash flow, they don't need to raise money. They don't need to dilute. And so again, it does just come back to patience.
Yeah. Just a couple of other, I just noticed some of your largest holdings in the gold mining space, Agnico Eagle, Barrick Gold, B2 Gold, Wheaton Precious Metals. Do you like B2 Gold? One of the Snowline Gold, which is one of my big success stories. B2 Gold is a major investor in Snowline, and I'm really interested because Snowline obviously is building that project. I don't know, they're coming out with a new resource, I think, but it's going to be, I think they're going to close into 10 million ounces, somewhere close to that.
Yeah.
And it's just very high grade, intrusive system. I mean, higher than almost anything else you can find that nature, bulk mineable, high grade, relatively high grade. And it's just, I'm wondering if, do you think B2 might have some ideas about getting involved and maybe building that thing?
Yeah, no, I definitely. It may or may not be Snowline, but as you know, their biggest mine at the moment is in Mali, which has its own problems.
Yeah.
They do have a mine in the Philippines, which has had its problems and may have them again. And as you know, they just purchased last year, 2 years ago, the Goose Bay up in the
way up north.
where is it? It's very close to the Arctic Circle.
Exactly.
And that's had some overruns and delays.
Yeah.
We don't need to go into details there, but I mean, the company are very, very good mine builders.
Yeah.
And they've operated in a lot of, less than desirable places.
Yeah, they were in Nicaragua. I think.
Yeah, in Nicaragua, they were
Calibre.
in Siberia.
Yeah. Right.
Um,
Well,
so
it would be good to have a safe jurisdiction like Canada, I would think.
Well, that's it. I think with what's happening in Mali, I think they want to increase their exposure to better jurisdictions. They've got 9.9% positions in a handful of Canadian juniors.
Yeah.
And that's why I say it may or may not be Snowline.
Snowline.
Snowline would fit because they've now got the experience of running in Arctic or very cold circumstances with Goose Bay. That would be a fit. On the other hand, there's a couple of companies that got large positions in in the Timmins area. But yeah, I think we're going to see something with B2.
Yeah. I just have to ask you about silver. What are your thoughts about silver? It seems as though it may be at that point where silver could outperform gold. Are you of that mind?
Well, it has outperformed in the last 2 months, of course.
Yeah.
Let's just look where it is. Yeah, year to date is more or less the same as gold, but the last couple of months has certainly had a lead. Yeah, I mean, as we know, silver tends to have these much sharper moves, both to the upside and the downside. I'm not convinced, to be honest with you, sorry to say this, but I'm not convinced that, as it were, this is it.
Yeah.
I think I would say that it's probably got a new floor now, and that floor is that floor is at least 30 and may well be 33. 33 looks like it may be the new floor. But I'm not sure that this is it. We're going to move to $50 or $100 in the next month or two.
Yeah.
For various reasons we don't go into. So yeah, I've actually been lightening some of my silver exposure in the last week.
Well, it had a nice move. So, and clearly silver, gold is money, as JP Morgan observed, and everybody should know that gold is money. Everything else is credit, he said, and I didn't. Silver too, I guess that means everything else. So anyway, any closing thoughts? Any ideas about how? I mean, here we're sitting with the potential for war, serious war, conflicts globally. The fourth turning. I don't know if you've read the book, The Fourth Turning. But clearly we're onto something really big going on now. Changing geopolitical forces. The BRICS obviously are competing with the U.S. dollar globally, at least in terms of transactions. The dollar still, I believe, is going to continue to remain a major currency for the foreseeable future. But nonetheless, it's losing a lot of its firepower. It's losing a lot of its transactions around the world, from what I can see, the statistics I see. So just sort of, I mean, and the West seems to be in big trouble financially. I don't know if China's much better, but they seem to owe the money to themselves, whereas the West, at least the United States, owes it to so many other people, as you've alluded to. As you said, there's all of this money that's owed, the foreigners, the Europeans at least, have been over investing in the US. So, I think you've got to be conservative, right? I think gold, short end of the Treasury, maybe, Mrs. Taylor and I have, 3 months and less short-term stuff just for liquidity. But just final thoughts about where you think people should really be focused right now.
Well, definitely gold would be a major factor, frankly, a major area, both for insurance, but also for the investment potential. So that would definitely be the number one. Other select commodities, but of course, other commodities are much more dependent on the health of the global economy than is gold. So gold is far and away the largest asset class we have. We like copper, we like uranium, but they are definitely way down the list compared with gold. And just always keep firepower dry. That's what if you've got firepower, you can jump into something that comes up immediately. And also, you never want to be in a position where you have to sell something for your liquidity, because inevitably you will have to sell at the worst possible time.
Right, that's exactly right. So keep the firepower so that you don't have to be caught in that position.
Yeah,
the gold miners are really making hand over fist, money hand over fist. I just saw visited with the president of West Dome in New York City at a one-to-one meeting. She's a South African mining engineer now that heads that company. It seems to have breathed new life into that thing, and it's just making tons of money. They got excess capacity that they're going to be feeding because they're developing their two mines. Both mines have excess capacity. Just no hedged gold, nothing hedged. So they're really realizing the full price of this gold, the $3,300 gold. And it's just beautiful. And they're going to have firepower. And I have to think they will be looking for some of those new mines that are being developed that you watch, the juniors that you're watching.
Exactly. There's a lot of new deposits in the Timmins that are within trucking distance. Exactly. So they wouldn't have to build a new mill or anything. No, you're absolutely right. We've seen people say, oh, the gold stocks are up 50% in the last 12 months. I've missed it. And it's too late.
No.
But if you look at the way the margins have expanded.
Yeah, exactly.
The margins have expanded tremendously. And so you look even at a big company like Magnigo or Pan American or something. They're all in sustaining costs of $1,250 or $1,300.
Right.
Some of the mines are $800 or $900 cash costs, but they're in sustaining costs. Yeah. Well, if your all-in sustaining costs have gone up from $1,150 to $1,300, let's say, but the price of gold has gone from $1,100 to $34, your margins have expanded dramatically, and the market is not, but the appreciation in the stock prices is lagging that increase in margins tremendously.
Yeah, it really is, and people just aren't recognizing it, but I think they will. And I think maybe what we have to see before that happens is some of the Magnificent Seven taking a tumble, and
agreed,
those overpriced stocks, having their comeuppance, I suppose you might say, at a point in time. Anyway, Adrian, very nice to have you talk to my people, and all the best to you and your funds. And I guess if people want to, they should go to your website and you're still accepting.
Let me just give you the best website, the easiest one to remember. Is adrianday.com.
Okay, adrianday.com. Excellent. All right. Well, thank you so much, Adrian.